Sure. Dan Weiskopf. Welcome everybody to the ETF Think Tank happy hour. Sometimes we like to have a little bit of a debate during the happy hour. So we're really excited to have Mark Neuman here today. I'm Dan Weiskopf. For those who don't know, I'm co-portfolio manager of Block and also lead ETF strategist for the ETF Think Tank. With that, I am going to hand it over to my colleague, Cynthia Murphy.
Hey, everybody. Cynthia, head of research for the tank. Thanks for joining us again. I have a great conversation geared up for you guys today. Hope you grabbed your drink. And as always, thanks for joining us. All you, Mike. Or should we go to Mark?
Well, hold on. Let me ask, because I missed this part. What is our drinking word before we go to our friend Mark?
Mark, you can introduce what you chose.
Oh, well, that's even better. So, yeah. Mark, let's hand it to you.
Today's word of the day is going to be confusion.
So, and Mike, you look very confused, by the way.
Yeah.
I think the derivative of confusion is the same, right?
Yeah. All right. Well, then let's let Mark introduce himself. Beyond being a friend of the firm, he's also got a fund in our trust he'll get to tell us a little bit about the strategy and the concept. But Mark, why don't you introduce yourself and your background, and we'll get right into the questions.
Thanks, Mike. I appreciate that. So yeah, I'm Mark Neuman, the CIO of Constrained Capital. I created the ESG Orphans Index, and the ETF is ORFN. This is the exclusions of the ESG bubble, if you will, over the past decade plus. It contains all the stocks that did not get into the ESG investment bubble of the past decade. These include fossil fuels, nuclear energy, weapons, alcohol, tobacco, and gambling. And they are what we call high expected return securities based on them being excluded and underinvested over the past decade.
Cool. So let's take a step back, of course. And Mark, you've done a lot of research on ESG. Let's start with the fundamentals. How far back did you start tracking ESG, and where do you think some of the flaws came in terms of the underlying foundation of the thesis?
Sure. So my jumping off point in doing the research came from a piece written by Cliff Asness of AQR called Virtue is Its Own Reward. One man's ceiling is another man's floor. And he talked about stocks under capital constraints and how virtuous investing has a cost to it. And that cost is, he said, in lower returns. You sort of can't get something for nothing. So you can be virtuous, but you can't expect to get the same returns as the non-virtuous investor. And when he talked, he mentioned tobacco stocks and the sin stocks. And I actually went back a few years, 25 to be exact, to do look at some cycles, sort of when constraints were on, when constraints were off, when they were back on. And then back in 1998, there was a tobacco master litigation. And a lot of the pension funds took that to say they could not invest in tobacco. And as a result, over that sort of few-year period where they were divesting, putting constraints on tobacco, the S&P outperformed Altria by about 45% in that 2-year period. And then at the beginning of the end of 2000, CalPERS and other pension funds said we were out, we divested, we removed the constraints from the tobacco sector. In that following period, about 17 years, Altria outperformed the S&P by 630% over that time, about 11.5% for 17 years. And then when the ESG bubble really exploded, and we could say that because between 2017 and 21, the AUM in ESG jumped by about 50%. And in that period, the 17 to 21 5-year period, when the constraints were back on, the S&P outperformed Altria by 130%. So then that's where I really dug in, because then Cliff's piece makes more sense to me. And I looked at which sectors had been excluded, had been under these capital constraints because of ESG. And I did that by basically digging into all the funds, see what they own. And then I did it from a stock to stock basis to see what stocks existed in which funds. And that's where I came up with alcohol and tobacco as the sin stocks, gambling and weapons too. And then the newer stocks, which I call the woke shame stocks, fossil fuel and nuclear energy. And now that it's sort of playing out a little bit, we can see on the macro level how that fossil fuel and nuclear energy is really creating higher energy costs and in turn higher food costs. And sort of that's the deep dive sort of research aspect behind the ESG Orphans.
Okay, so I think this is probably going to be new to many people. So the index and product that you've created is all the things left out of the broad-based industry funds because of various different ESG metrics. So you mentioned tobacco, alcohol, fossil fuels, uranium, all these things. Now, one of the things that I've often seen on the other side, right? So like the concept is, if I get it right, that these are left out of portfolios for reasons that are non-economic, and that's leaving some alpha on the table. Here's a way of almost a completion portfolio. But one of the things that I've often heard and like, you know, I've seen just through the narratives and things is that all the ESG data is very different, right? Like, you know, well, I see Alex shaking his head, like what Nuveen has versus what MSCI has versus what Deutsche Bank has versus what S&P is producing. And yet, I think, you know, from the standpoint of inclusion, they seem very different. If you look at just putting together a portfolio of what they all generally exclude, it sounds like it's pretty similar. Like, when you're thinking about exclusions, does the data seem a lot more consistent than when they're trying to promote up something with positive social impact?
So yeah, that's a great question. So MIT wrote a piece, and this was another bit of my sort of research that I uncovered. It was entitled ESG is Aggregate Confusion. There's the
There
word.
you go.
There's that word. And, you know, when I did the digging in, at the time, there were about 10 rating agencies. Now there's closer to 20. But what I found was, say, for example, in Facebook, on one of their E, S, or G ratings, say Sustainalytics is one, ISS is another, Bloomberg ESG is a third, let's say. You could find a rating in S, let's say, top quartile, middle quartile, bottom quartile, from each of those ratings groups. So that was where I really looked and found the massive inconsistencies. And again, as you said, Mike, the only thing I found consistent was what they all excluded. And as I went through the funds, you could see that what one fund excluded, other funds may have had in there. And what some funds actually included as ESG turned out to not be very ESG when you dug in. Or let's say Coca-Cola, for example, they have an Indian CEO by the name of Indra Nooyi, an Indian woman. So they get, you know, that helps on the G score, the governance score. But when it comes to social or environmental, I find that their contribution to obesity and diabetes on the social side is, to me, a failure. And I find that environmentally, the plastic water bottles, Dasani, Aquafina, I can't remember which one's Coke, but those plastic are sort of a failure in the E, environment. But then you find that Coke and Pepsi exist in a lot of ESG funds. Now, they may be great investments for a slew of reasons, but they're not, in my book, going to make it on the ESG score. And another one might be Amazon, the world's biggest global carbon footprint. Amazon may be a fantastic investment for a lot of reasons, but it can't be the third biggest holding at BlackRock's ESGU and Vanguard's ESG on account of ESG. So that is where that confusion comes in.
I like it. So I'm going to go one more question and then fade into the background a little bit here, because I can go for hours on these subjects, because, through the ETF Think Tank, I've worked with hundreds, probably thousands of advisors, and hundreds have definitely asked for ESG advice. And we've brought some really great solutions to them, right? Because, I have found that even if they don't believe that it's increasing performance, or if they don't believe that it's changing the world, without a doubt, they believe it's a way of them engaging with their clients.
Mm-hmm.
Right.
Absolutely.
And look, I'm proud of some of the ones that I've been involved with. Right. So like I did Karma back in my Global X days, and that's very specific version of ESG. In fact, we didn't use the term ESG anywhere. We used the term conscious capitalism, and it was all about a multi-stakeholder approach. And it wasn't the shareholders are one piece, but so is the community, and So there was, that's a story I can explain and all that sort of stuff. And then we have social justice in our trust as well, which is hilarious that we have social justice in our trust and the ORFN at the same time, but I don't actually see a contradiction there, right? I see it as they're using very specific metrics and they don't use the term ESG. They use, that they're looking for justice for the cohorts that are the type of people that they invest alongside. So I'm saying a lot to get to a point of,
thank you.
In my mind, thank you, Dan. I'm teasing you. I didn't mean to confuse anybody.
I thought I was on mute. Oops, sorry.
My point is, I've always found that true, whether it's ESG or whatever moniker you want to use, but real investing along that way is more customized and needs to be more specific and less broad-based. And I think that what you're really preying on, or not preying on, or almost exploiting the fact that so many people have gone so broad-based with this that they've missed that customization and they've created an anomaly in pricing in securities. But I'd love your thoughts on the customization and the more specific. I love that on your website here. I'm just actually going to pull it up. I remember talking to you about this a couple of weeks ago. The whole statement about, you only use recyclable water bottles. Your point was, hey, for me, I have a customized vision of ESG and I live it. But
that's,
you go ahead.
That's right, Mike. It really comes down to what clients in the end want, right? What's the tailored solution? But to take a half a step back, I think there's a very big discrepancy, or disparity is probably the better word, between living an ESG life and investing in ESG. And the second one is much harder than the first one. I mean, the first one, as you say, we use Swell bottles and Hydro flasks in my house. We've eliminated 99% of plastic bottles. And my son, this past summer, was in Peru planting some saplings in indigenous village as part of a service trip. Yeah, he did get to see Machu Picchu, but the exchange was a big service program. And so if everyone planted more trees, we'd have a lot less climate issues. And as far as sort of, the diversity and aspect of things, I do believe that the multiple inputs on solutions from a broad base of perspectives provides very robust solutions. But what's happened here in the ESG community is Wall Street took this great idea and mashed it into something that's what I'd call unrecognizable. And we've seen this before, though, on Wall Street, from Michael Milken in junk bonds and Louis Ranieri in mortgage bonds. And more recently, the parallel I make is the CDOs and the global financial crisis, where the rating agencies were captured by Wall Street, Fitch, Moody's, slapping AAA ratings on stuff that was completely not. And then it got into a real messy situation. Now we talk about the custom solutions. Where I think ESG has taken a turn, not a good one, is where many people's investment money with, let's say, the elephant in the room, BlackRock, maybe it's retirement money, is being used to push preferences of certain people and not those who have their money in that spot. So I think one of the things that I really thought about in coming up with my product, and look, I don't smoke, I don't use tobacco. I barely drink. I mean, I'm drinking a club soda here just because now that I'm old, I can't drink as well as I used to. But I mean, I had a beer with sushi or whatever, but I don't drink a lot. But the point is, I'm not telling people what to do with their social preferences. If people want to give to Greenpeace or not, if they want to support the NRA or not, that's not my decision with their money. My idea here is, as a fiduciary sort of responsibility, we're going to put your money where it can get the best returns. And then you can take those best returns and do what you want with them. So I think that that's a distinction. And I think ESG, as we know it now, and being lured into I invest in ESG funds, is a little misleading. And I think you really have to be specific and sort of, it's that Peter Lynchism, know what you own. And I just don't know if everyone who's investing in ESG at this stage knows exactly what they own and why in the ESG context.
So I actually think this whole ESG as a category was a mistake from the beginning. I think to talk about confusion, are we talking about, is a company ESG because of the way it runs its business? So it has a very conscientious footprint, and it has good governance, and it's good to its people, so it fits that criteria? Or are we investing in a company because of what its output, what product it has in the market, and that product is environmentally friendly, or it's socially conscious? Or so right there is already, I don't know what's the purpose. Are we going after what these businesses are putting out into the world, or how they're going about putting this stuff out into the world? Problem number one. Problem number two is the environmental story is completely different from the governance story, which is completely different from the social story. And here we're putting the three together. So we spent years in the business complaining about the smart beta label because it was confusing, didn't explain, and it didn't really help anybody. And then we outdid ourselves by coming up with the ESG label, which is even less helpful and more confusing.
I don't think we can blame ETFs on ESG though, but
Sure,
you've got a really good point though. I'm curious if anyone knows where it comes from. Like, why did they mash these three things that really don't go together?
And how do we unravel it now? So, every conversation ends up in we need standardized data, but where do you even begin with three completely different beasts that are talking either about a business model or a business output? I don't even know actually where we go from here, other than just sit and debate and not know what we're doing,
Yeah, I follow you, because Mark, is there anything in your index that's been left out because of governance? Like that's in there because it's excluded from other places because of governance?
No, not specifically. The index really, the underlying theme on the index ends up being stocks that are under constraints of capital. And it could be for G, it could be for S, it could be for E. In terms of the specifically, but see, here's the thing, Mike. If something, say, fails with governance, it may be included. Like, it may be included for the other reasons, the E or the S. And I think one of the things that Cynthia brings, which is super important, is the sort of evolution of ESG from here. And I think that it will not be binary, right? I don't think it's going to be black and white. I think it's going to be some 3D evolution, a little of this, a little of that. And I do think that's important what you said there about the way in versus the way out, because there are guys now talking about the inputs and the intentions versus what comes out. And they may end up shifting it that way. And I think that the E, as you said too, with the three items, E is going to become a bigger focus in terms of emissions and those sort of things. But one sort of current evolution in the system that is really important is how these companies are answering the due diligence questionnaires that come in. So I spoke with a couple people on the ESG internal side of these companies, and you'd be surprised how many said we're getting really good at answering the questions. And this is what Aswath Damodaran of NYU, the Dean of Evaluation, I think is his nickname. I chatted with him briefly, and he mentioned that people are now gaming the system, right, to answer the questions. And if we remember a couple of months ago, the whole Exxon and Tesla thing, right, when Exxon sort of improved on the ESG score and Tesla didn't on a relative basis. What had happened there was Tesla, which by the way, I don't think has a great governance record, among other things. They hadn't really changed their ways much, but what Exxon had done was they divested some of their publicly visible oil wells and improved in their ESG score because, hey, we divested. But interestingly enough, and this, I'm going to not say the word right away, but I'll say it. This is where, say, for example, a private equity firm, a couple of them, buys those assets from ExxonMobil. And it could be an Apollo, it could be someone in the Middle East or whatever. And the actual equation in energy doesn't change. But Exxon's rating does because they've answered the question of have you divested, but the actual energy output, because a private equity group has taken over the assets and resumed the pumping of oil, if you will, hasn't changed that. So that's where more of this confusion comes in. So it's a continued sort of ongoing debate. And look, the truth is, the industry has gotten so big. And when I say industry, I mean the ESG industry. Revenues in the multi-trillions, assets in the multi-trillions, the revenues from fees, compliance, regulations is gotten in the billions so that it behooves people to keep the shell game moving, if you will.
So
there's a lot of people who
Dan, I think Alex wanted to chime in, and I think it's time we get a debate going.
Well, and I think one of the things that, and I'll be full disclosure, I've been doing factor investing, smart beta for a long time. Now I cover ESG, but I think one thing that I'm curious about is just this idea of intellectual property, because an active manager that's the intellectual property. You're buying that manager's ability to do something, some sort of result, right? When I think about index providers, all an index provider is a data provider. So when you think about like factor investing, I could go to an index provider. If I had my own intellectual property of a multi-factor solution that hits a certain thing that no one can do or has done, then that's my intellectual property. So, at the firm I'm at, we've been collecting the data for 50 years. We use a provider that has the broadest data set. So for us, all we're saying is we're taking their data set, which is the biggest and the broadest, and articulating that in a way that solves for a portfolio problem. And so I guess I mean, I've agreed with a lot of what you've been saying. I just think that there's a difference between the BlackRocks of the world that basically are taking MSCI's published research and slapping their name on it and producing it versus a manager that's been doing it and then sitting with an index provider to build their view of it, right? Because I think at the end of the day, what an investor wants is they want to buy the intellectual property. What is it that you do that's different? Now, I would also say that most of the ESG stuff that's out there does look very, very, very similar. There's not a lot of added IP in any of this stuff. It's literally taking the index provider's research and putting your name on it and basically saying, I'm BlackRock, buy it. And so I do think there's a little bit of a difference there. And the only reason I say that is I pull up attribution. I look at our ETFs versus the 4 basis point beta. I've got 5 years plus in a crazy market, and we're doing 20 to 40 basis points per annum at the less risk, little tracking error. I didn't believe it. I still don't know that I believe it, but I'm looking at the numbers of the quant that's been doing this, and it works. I don't know why. I wish I did, but there's something in there that I can't, I deal with these ETF nerds all the time. I'm trying to figure out the reason that this doesn't and won't work, but at the very least, we haven't lost to a benchmark. And so that's where I kind of come back to, it's the intellectual property. It's your ability to take your secret sauce and apply it in a way that solves a problem.
But Alex, you're saying what I said earlier here. You're more specific than just the MSCI
Right.
slapping data.
Right, and I think that's the confusion.
Yeah.
Chug
Thank
it
you.
up. I think that's the general confusion to most investors, is because they don't understand where the recipe is actually coming from. They're looking at it and they're saying this thing's got volume and it's the cheapest and it's got ESG label. But I would also say too, the point about engaging with your clients, I think that piece to it, whether good, bad, or indifferent, I don't think a lot of advisors talk to their clients very well. This does open up a much better avenue, whatever side of the fence you want to be on, to talk more about what your client is important to your clients and to bring them closer to you to have stickier assets.
Yeah. So Dan, before we go to you, I just want to show a data point on what Mark noted, which was the economics. So I'm bringing this up because I want to share more often. This is right on the ETF Think Tank website. Anyone can use these tools, but if you look at US equity or equity focused ETFs, you're at an average weighted expense ratio right now of 16. Just to give it the Ben Hunt kind of angle, right? Why is industry going there? If I switch this just to ESG equity, that number jumps up to 18.7. 2.7 bips makes a big difference in the world of Wall Street when you're talking about this. What was surprising was the average expense ratio actually went down. The weighted went up, right? So if I go back, the average, if you just look at all equity, is going to be 48.6, but weighted, say. So just wanted to share that, Dan. You can take it from there. I just wanted to point that out, that there is an incentive for Wall Street to look at this space. We're definitely charging for it.
When did we go below 19?
That's just equity only. It's not the whole industry. I was showing equity only.
So I'll go back to a discussion that Cynthia initiated maybe a couple of weeks ago on the show. And it may be too narrow, but, should we launch individual ETFs as in just the G and just the E and just the S? Cynthia, if you want to expand on the idea, but it's and help Wall Street define it, because I just don't know if markets are going to be as efficient or regulators can be as efficient.
Yeah, I don't know. It goes back to the point of not to say confusion again, but the confusion of it is just, in my mind, these are three very different themes, and the only underlying common denominator is the feel-good story that unites them. There is no other narrative out there. So, is this actually as a category doing a service? So to Alex's point, the outperformance has been there. It's lower risk, but that doesn't necessarily come across when we're debating what are the metrics, I think that actually gets lost in the conversation. And then the minute we bring that up, that conversation about what you're actually getting in terms of risk return, then it's like, well, this isn't about outperformance. This is about investing for the future. So you get dragged back down into the feel good story, and we're in this kind of trap. We can't seem to move past it. So I don't know how we get out of this rabbit hole we put ourselves in, and whether it's breaking this apart. A lot of times when I was at ETF.com, we spent so much time trying to break away from the smart beta and trying to be better than that and be more specific. And the truth is, once it sticks, it sticks. You can't undo it.
Yeah.
So I actually don't know what to do from here, because I think it's out, it's there. So we just have to figure out how to navigate and make it useful for investors. I actually think if I had to go out and pick out an ESG ETF today, boy, that's like a huge, huge burden for any investor out there to go try and navigate this space today, which is why, the conversation always ends up on what BlackRock's doing. Because you just go, okay, that's the biggest, that's the cheapest, okay, whatever. I don't even know what I'm trying to do. So it's a really tough spot to get out. But Mark, go take it away, Mark.
So I think that we're still going to come back. I do think it's going that route. And as we discussed earlier, I think that there's probably, if we talk about which is the most measurable, I guess you could probably point to the E and say that that's probably the most quantifiable. The least is probably the governance, I would think, because you can sort of measure societal impact. Like if we talk about the cost of, let's just say, alcohol or tobacco or, you know, medical conditions, whether it's obesity or whatever, on the social net or this of our society, I think that's probably more quantifiable. Governance is probably the least. And I do wonder, though, in the end, who's the arbiter, right? Who's the decision maker? Right now, as I said, when I started, I think I mentioned this, but when I started looking into this, you know, 3-4 years ago, there were like 10 different rating agencies. I think now there's closer to 20. And I also think a couple of them have bought each other such that, you know, it's almost like not quite monopolistic, but it can be. So there's a bias there. And, you know, in 2008, during the global financial crisis, as I mentioned, the CDOs were rated AAA when they weren't by a captured ratings agency, whether it was Fitch, whether it was Moody's, whatever. And I think that's an inherent risk in trying to solve for something that is as broad and, let's be honest, on some levels subjective. Again, what's quantifiable and what's qualitative or a little more subjective, I think that is what makes it so difficult. And I think that, you know, I would say one thing I can say with some certainty, I think the ESG situation, the ESG investing landscape has been forever changed. My view is because of what Russia did in the last 6 months. And I think as a result, now we're soul searching and we're saying, what are we doing here? What have we done? And the truth is that on some level, I definitely, you know, love nature, but I have to feed my family, clothe my family, and shelter my family before I can worry about whether enough trees are going to grow in my backyard. Like, so at some point, there's a little bit greater focus on what's right in front of my face versus sort of that luxury of being able to say, I can care about all these other things, which are important, but as I relatively value them versus feeding and clothing my family, I think that's where we as investors sort of need to make hard decisions. And I don't think there's a, like you said, down the rabbit hole, how do we get out of this? I don't think it's an easy solution, but I think that, you know, it starts with being sort of as objective as we can to what are we trying to solve for and what can we really solve for?
Very cool. So I want to cover and unpack a couple things there. First off, on where should the data come from, right? So a couple years back, I got tapped or we got hired to work on a project called Impact Shares. Still exists. It's very small, but one of the more proud things I've done, especially because we didn't really get paid for it because they never had any money. we actually got them a grant from the Rockefeller Foundation and all that fun stuff. But Ethan Powell, who ran the company, had this saying that, you know, ESG, the E is not that debatable. The G in his argument wasn't that debatable. I'll come back to that. But he called the S the messy middle, right? Because if you're a Catholic values ETF, you have certain opinions on female reproduction that a different fund may have very different opinions on female reproduction, right? So the S can be completely different if you do social funds, right? Governance, interesting enough to me, was always one that I like the best. And it's really hard to just do an overall governance, but very specific things did exist at one point in the ETF world. They don't anymore. So there was an ETF called Flag that looked at forensic accounting of companies and really went through their books to make sure that there was no questionable things going on. That's a form of actually getting down to governance. There was a couple of ETFs that looked at insider buying and insider sentiment. There was 2 of them, actually. They're both gone. But insider investing and ownership, that's governance, right? Like that's a way of measuring good governance above and beyond the social part. Well, you know, like the Indian female CEO, that's more of a social thing than a governance thing. I just wanted to throw all those out there. Now I want to go down a new rabbit hole. I'm going to do something quite meta here for a second. And I've experienced this a lot in the last couple of days. So this is us live on Twitter, right? So I started looking at the comments. The backlash against ESG has just come really, really hard. I mean, this didn't exist at all 6 months ago, 8 months ago. Like, we're being called demons because people are misinterpreting that we're pitching it right now, right? So I was on a call yesterday with an advisor, Dan and I and Guyad, that's very much been into ESG, and they told us clients are calling them saying, "Why do I have ESG funds? It's a political issue." So, Mark, this is obviously the moment for your fund, right? You brought out this fund, this concept at a time where there is a backlash to it. My question to you is, if the sentiment is gone your favor, what is the investment case, and where does somebody use a fund like this? Is this a replacement, a completion? What do you do with this idea? Why do I want to invest in the companies that have been left out of or constrained by these ESG movement that is now being backlashed heavily?
Right. So that's a good question as well. So I'll give an anecdote first. A few months ago, I got a tweet. Someone tweeted something to me from Europe. I think it was the Netherlands, and they said, "Mark, I have an ESG analyst job. Do you want it?" And I kind of said, and they said, "Well, it pays £100,000 or 100,000 euros, whatever." And I said, "No, actually, I don't. But if your career success is tied to ESG, this is a perfect hedge for that kind of person. If ESG doesn't work, this is sort of the offset." And look, I would say this. You asked, I don't think, look, it's not a core. Well, it can be for the certain investor as that position. But I also say that I think the ESG infection in portfolios is pretty high around all around. And I think this is sort of an immunization of ESG. And I would say that, I kind of liken it to, in 2000, there was tech and the Qs. Qs got launched and to isolate that tech factor. In 2010, the VXX got launched to isolate the vol factor. It was an ETN, but similar idea. This, I believe, because it's diverse in the sense of a little bit of fossil fuel, a little bit of nuclear, a little bit of weapons, nuclear energy, weapons, alcohol, tobacco, gambling, it has isolated the ESG factor. So I view ESG factor isolated by ORFN. Now, for some, it's a nice portfolio barbell. In other words, the characteristics of this index and the ETF are a 0.8 beta or so, lower beta than 1. It's got dividends over 3%. It's got price to book, price to sales, price to cash flow, pretty cheap relative to a lot of things. And it produces mostly hard goods, real assets. It's sort of, if you want to go long the Qs or go long ARC or go long biotech, sort of highfalutin stuff, this is sort of that balance in your portfolio as well. I mean, in the end, it has value, defensive, dividend, those kinds of characteristics. So there's a lot of aspects. And in the end, I view it, so for some, to be a hedge to ESG risk in general, both on a macro and a micro basis. And then for others, I think it's an opportunity to be a contrarian reversion, anticipating a reversion of flows. Over the past decade, technology has doubled as a size in the S&P. Healthcare is huge, and utilities, energy, industrials, which is part of the weapons, and materials, which is more part of that ESG exclusion type, have all shrunk. So if people are saying what led us the last 10 years is not leading us the next 10, then that's the kind of investor that this would appeal to, I think.
You have a question, Dan? You have your hand up.
Yeah, you know, a couple of things. I'm going to challenge you a little bit and probably get my head cut off, and say that there are different cycles of returns, right? And the last year, you've been absolutely correct, but in the previous year, ESG was killing it, right? The previous 2 years. So I totally agree with you that definitions need to be defined better. And my question would be, is it up to the SEC to step in and force asset managers to define it, or index providers to define it? Because I wholeheartedly agree with you that definitions need to be clearer, because listen, investors are getting misled.
So I think that this question, it's a good one. I think that it's going to depend a little bit on the swing of politics. And I say that because in the last few months, the Supreme Court came out against the EPA and said, you guys need to back off a little bit on your overreach into the corporate behavior. And then I wonder, does that mean that the Supreme Court may say that to the SEC next going forward? But then there's also the case of, you can see Ron DeSantis in Florida said the pension funds no longer need ESG as a guideline. So I think as the political tide shifts, if it does, not as, if it does, this will dictate how people view ESG and what they expect from ESG. And I think that, we've seen it as well from a large number of attorneys general coming after BlackRock. So there's a growing bit of maybe more heavy political influence that may try and dictate who defines ESG and how, I would say.
All right, so
my dog in the background. Sorry,
it's all good. We love having dogs here. We have to feed Rex at the beginning of every show. Are there any questions from the audience? Because we're coming towards the end of the show. It's been pretty interested. Alex,
Mark, I got a quick question. I'm just curious more of like how you think about, like, ESG to me is more of an integration story, like taking a benchmark and trying to bounce it against something, but like a TAN, right? That's solar. That's like a specific, right? So I think part of the discussion that I see a challenge in is that there's this difference between taking a benchmark that somebody knows and trying to enhance it, whether it works or doesn't, and a strategy that's more impact focused. Because to me, if it's impact focused, people care, as investors, like millennial investors, they care less about the returns and more about the impact that they think they're having for good, bad, or indifferent, right? And so I'm just curious your take on how do you look at an impact type strategy differently than ESG, or would you put them in the same camp?
So the underlying thesis for me has been which companies were under constraints of capital. So someone asked me about Berkshire, and I think we could all agree that Uncle Warren is never really going to suffer from constraints on his capital. That's sort of one that was like excluded from the discussion in that way. But in the end, there are other sector-specific type funds like this. There's Vice and there's Bad. Those focus on betting and drugs and the Vice stuff. There's another one that's out as Drill, right? The Strive guys and their corporate push more than the stock level. Push.
BOTE is the same kind of thing, right? Like,
right. But for those, I find that as from the investor angle, there's that sector specific risk, right? If all the oil stocks go down, Drill's going down. And so for me, in terms of the way again, back to my North Star, it was sort of constraints on capital. And it was sort of a snapshot of ESG at this time, which led me to say, this can't go on as long as it has. And, as a result, my thesis is and was and is ESG as we know it is going to change out of necessity. And so I look at it from the stock and sector specific angle, and don't sort of judge on the impact perspective of their behavior, so to speak, if that makes sense.
Mm-hmm. Yeah, it does.
So Mark, I've got a real quick question that's aligned with what Alex just asked. To be added to your universe, right? You have specific requirements. Here's the question: are pawn shops in the universe? Because I always like to. Sorry, Venuto, I had to throw it out there.
I mean, is there even a public pawn shop?
There are 3 of them.
Which ones? What are the public pawn shops? Okay, let's hear.
Are they publicly traded? So are they publicly traded and big enough to really make it? And that's the thing. Like, think about the gambling aspect of my index. It's only about 4%. Now, I included it because it is excluded, and it does have higher cost of capital and is under exclusions and capital constraints. But as a market cap weighted index, the ExxonMobil is bigger than the entire gambling industry. So it's included in my rules-based index, but it really doesn't register as a significant component. It's 4% because it's market cap weight based. So I think that, that's also why, for example, let's talk in the nuclear sector, for example, I actually personally, I might have a better flavor or like of Cameco, CCJ, but Nextera is the big one in the room. And the truth is that I wanted these names. I wasn't going to be a stock-specific stock picker. It was a sector and theme, and I wanted it to be the biggest and most liquid. I mean, the underlying index is $3 trillion. 50 names, 60 billion average. So if we get an exodus of a little, let's say the $8.5 trillion monster that is the big 5 or 6 tech names, into a small portion of that market cap comes out and pushes into the fossil fuel and nuclear basket portion of my basket, which has a market cap, the top 10 of about $1.7 trillion, from 8.5 trillion to 1.7 trillion, a couple percent out of that big basket, rates go up. Everyone's like, I own Apple at 7.5% of the SPOOs at 28 times forward. Why do I have that? If a little comes out of there, just think how much could go into that space. And I'm not saying it's going to be 1 for 1, but if people who don't know that they really own as much of that stuff as they do start to migrate, it just takes a little bit of that migration. So that's really part of the thesis and the theme henceforth.
We'll take it offline, but First Cash has got almost a $4 billion market value. Mr. Venuto.
First Cash.
Yeah.
All right.
Bye.
But they may have great governance, Dan.
Oh, they might have. Yeah. Fair.
So listen, we're coming to the end here, but I've come to realize something in this discussion that I didn't get in previous discussions with Mark about the idea, and Cynthia, it actually relates to how we categorize it. I'm now realizing that, Mark doesn't hate ESG, right? Like that's despite the comments in the Twitter sphere and all that stuff. I knew that part. I'm just teasing. But this isn't really about ESG. This is about an anomaly, right? So this is what I would call a characteristic ETF. I just put a link to a paper we wrote 10 years ago about this concept of characteristic ETFs. And it's where you find a business structure or an anomaly in the way that business is being conducted that creates an exploitable financial outcome, right? So examples in the past are companies that are doing buybacks, or companies that are going through a spinoff, or companies that have high insider buying, or companies that have high ownership by hedge funds. These are companies that are been capital constrained. That's really the key to it all. They're left out, and therefore they're mispriced. I don't know if anyone else has heard this story, but Ben Bernanke used to say he only owned one stock. It was Philip Morris, because it was mispriced, and he reinvested the dividends. So, Mark, I asked a question earlier. I'm going to answer it now. Where is this used? This is a theme or a characteristic that, if you believe that ESG is causing mispricing and things, here's your way of profiting from it. And you can use that later if you like. And
Mike, the answer is yes.
Yeah.
Period. End of story. And then the other thing I would say, when I look at those companies, they tend to be recession resistant, and that's why I was thinking about.
That's why you like the pawn shops. I know. It's his. And for those who don't know, that's what he wrote his master's thesis on. So it's near and dear to him. So why don't we wrap up here, Mark? Do you have any last words that you want to share with the group? Resolve any confusion?
Yeah, just confusion. Got one in there.
Yeah.
Just real quick, I would say two things. Number one is the orphans concept. It's funny, you mentioned it earlier. You mentioned the word ESG, and everyone gets their hackles up. I had a few people who were ESG investors who, once they read through, they said, "Oh, well, we're into ESG, so we don't want to." But they see the word ESG. The idea of orphans, that's not a new concept either, right? Orphan investing is the excluded, the outcast, the underfollowed. So that's not an excessively new term either. And then the other thing is on energy, and I just want to reiterate this point. I say it within Constrained Capital. One of my theses on oil is you can't get to future energy without present energy. And I liken what is going on right now with the energy situation to everyone's on a boat, the USS or whatever, the SS Energy. And the ESG captain comes on board and comes over the speaker and says, "We need a new boat." And I think we could all agree that, yeah, maybe we do. But rather than us all meet in the stateroom or in the think tank and talk about what the future of the boat looks like, the captain said, "Everyone jump in the water and let's swim, and we'll figure out the boat." And I think that's a real missing a few steps. And I think that is going to be really crucial and really critical going forward as a real big issue in the next few years. And I think that's something for everyone to just think about. It's going to be a big deal.
All right, we'll wrap it up here. Thank you, everyone, for joining us on Get Think Tank. Thank you, Mark. I put links to the ORFN index in the chat, so we'll see you all next week.
Thanks a lot.
Thanks.
All right, thanks, everyone.